Oh, this one? That's a good one.
Yeah, it was fun.
You want a mic?
I'm not sure. I think we can do without a mic over here.
Okay.
Okay, I
Fine.
think we're all.
You usually stand there.
Oh, did we want to move these chairs up front?
Oh, that's fine. He can just stand. I'll just go sit in the corner. Yeah, right next to him.
We'll give people another couple of minutes to get here, and we'll wait for 11 o'clock to get here. Now, are either of you using overheads?
No, it's more Q&A this week.
From the heart.
From the heart, exactly.
Oh, let's see who we have here. We have Thompson is here. Thompson is here.
Hey, yeah, I'm here.
All right. What do we have to pay to get your screen on? All right.
All right. I'm just,
All right,
you know,
welcome to Rice University.
all right.
Okay, we're going to get started here because this is on our Zoom side. And I don't want to take up too much time, but I want to remind you that the CME trading competition for 2021 is going to be in October. And so if you are interested in, if you know anything about the Chicago Mercantile Exchange Group trading competition, you know it's a realistic trading competition. And anyway, the Rice has won a couple of times, and if you're interested in that kind of stuff, let me know. And I'll get you into, we'll put together a team if you can handle that. All right, so I assume you guys are still attending your seminars and that you read the Wharton commodity paper for this week. I certainly learned a lot by reading that. That was a very good paper, and it's a good reference to give to people if they're first starting out or have been in the commodity business a long time, because you forget stuff too. So this website is one that Max gave us, and it's called The Trading Game, and you're supposed to outperform the market. So first thing we'll do is we hold the mouse down and then to buy and then to close or to open, and then so I'll hold it down, it's not doing too much, and then I let go, I close the position. And I can do it again like this, and this is a real sleeper.
It's intraday.
This was Frank.
Okay, this must, all right, so. The time is up. My returns are 0.3 against the stock's loss of 2. I outperformed 84% of players, ranking 159. How do you like that?
There you go.
And that was with random buttons not knowing how to play the darn thing. So maybe if I knew how to play the game, I'd be closer to 50. So with no further ado, let me turn this over to Max.
Hey guys, great to see everyone again. And I guess we have more people on Zoom this week. So this week is kind of like we said, buy-side week, and sort of going over, we have Mukul and Thompson who have graciously sort of come to join us and talk about their experiences. One of the things I think we're going to, hopefully that they will sort of focus on is, again, thinking about, I think, loss management, which is something that we don't really talk that much about in a academic standpoint. We always, in classes, they'll go through like the functions and, how do you measure, what your drawdowns, your VARs, and, it's very numeric. But I think that something that's very underappreciated, something at least that I underappreciated when I first started as well, was, there is definitely an emotional standpoint to it, no matter how quantitative or how data-driven, you are. And I think that, over the short time that I've been doing this, and, the Thompson and Makul can speak more about it, but I think that ends up being what really differentiates people that succeed in sort of trading and portfolio management. Long term, there's a lot of people that are very smart that do a lot of things, but I think sort of being able to segregate and sort of deal with, your own biases and how to deal with multiple losses, maybe some larger than you might have expected. It's a big thing, and also not letting it impact, your personal life too much. Because at the end of the day, it is a job. So that's something that I think that they have a unique sort of experience on, because in the buy side, like we mentioned in week one, your salaries tend to be lower, and your payoff really is just a function of whatever it is you produce. So Thompson and Makul both worked on the sell side, and they've gone different ways. Makul actually trades his own money. And so I think that they, it's a good thing that they can sort of elaborate a bit more on, in addition to some of the other things. So without further ado, so I'm gonna let Mukul come up here. So I'll just as a bit of an introduction. So Mukul Khandelia is the managing partner of Quant Roll Capital. So he was actually my first boss way back when, before he decided to go off and do his own thing. So he manages his own money on the exchange. So in the sense that you think that, my team does things on the exchange, he's pretty much the exact same. He just does it from himself. Still focuses primarily in commodities, but, is always looking to sort of expand. And prior to that, he had worked, effectively in a similar role as I did in commodity index, started here with Bank of America Securities and Merrill Lynch. Thompson is a mentor friend of mine. He actually tried, potentially at one point, I think, to maybe hire me away from Makul way back when he used to run the index desk at Morgan Stanley. It's a very high-powered, obviously, investment bank, and just, I think, in the last year or so has moved to the buy side from being one of the co-global heads at Morgan to Gunvor, which is a fund that is starting more of a systematic financial arm. And he is based out of New York, but Gunvor is actually, I think, primarily focused here in Houston. But anyway, so they both, been in the industry for a very long time, have done risk in a bit of different ways. And so, we have a couple questions to kind of go through, but as well, obviously the class here is smaller today. I'm sure we can get the questions from Zoom somehow. But I'm gonna let them sort of talk a little bit about themselves, work through some things, and then, whatever, everyone has any questions, we'll go from there. So, if I could start, let these guys kind of introduce themselves a bit more in a little more detail. So I guess, Makul, if you wanna talk a little bit, and then I'll hand it over to Thompson.
Okay. So let's keep this as interactive as we can. Anytime you want to stop me, interrupt me, ask questions, feel free to do so. So I primarily, my background is in computer science. So I was actually, before I joined Merrill Lynch, I was actually working as a software engineer in Silicon Valley. And this was around about 13, 14 years ago. And then, I kind of figured out, this is getting boring. There's not a lot of money in tech. Finance has where all the money is. That's where all the action is. There's a housing bubble going on. It's a lot of fun. I need to make some money, so it's all a matter of timing. So I managed to get admission to Berkeley in the Masters of Financial Engineering program, and that was close to my house. So I decided, let's do something different, kind of thing. And after the financial engineering program, I managed to get a job in Houston, and I was pretty much one of the oldest kids in class. So the only reason I managed to get this job was, I was one of the few people who had a green card. So in an engineering program, there are a limited number of people with a green card, and Merrill Lynch had a requirement: either you have a green card or you're a US citizen. So that pretty much kind of did it. So after moving to Houston and coming to an investment bank, I was all completely wide-eyed. Like these are the masters of the universe. They know what's going on. Like I didn't understand anything. I thought everybody would pretty much know what's going on, and everybody had like these huge number of screens, Bloomberg charts, wearing ties and shirts and everything. But as it turned out, like at least in commodities, things were like a complete shit show. I mean, it was like, and I was actually hired as like a quant person because I think the only person I would join the index desk, and the only person who kind of understood the indices, he was actually leaving for some reason. I heard whispers of fraud or something, but I don't know. So after I joined, it was like, I tried to ask questions and everything, but really nobody understood the index mechanics. It was like pretty strange. Like we were an index desk, and all the traders, they just didn't understand anything to do with the indices. But it was like a slow process, I guess.
And timing, this was probably like what, 2011-ish?
This was 2010.
2010, so
Yeah. So we were like starting out, there was a big thing. There was a lot of money flowing into indices, especially commodities, because it was like a new thing. I mean, at that time it was claimed like commodities is like a new asset class. So if you're putting so much money into equities, you should be putting like 10% of that money into commodities. That was how they put it. Obviously, that never came to fruition, and that's a good thing. But there was like a lot of data out there, and nobody was really like looking at the data. The traders, they used to look at all these charts. I don't know what is it about technical stuff. All the traders tend to look at like technical stuff, and they still look at it. I mean, there is nothing to be gleaned out of technical trading. There's nothing there. You keep drawing all different kinds of lines, and you have resistance patterns and stuff, and there's nothing there. And that's all they traded based on. I mean, once you start looking at data and you know what you're looking for, there is like so much, and especially like there were so many opportunities back then because there was like so much inefficiency kind of thing. And I mean, just looking at the data in a spreadsheet and doing stuff, you could do so much with it. It was like pretty amazing, like how much there was, but there was just like nobody doing it at that time. Yeah, so slowly, I mean, mostly people won't even listen to me most of the time. But then I figured out, like, if you draw like a nice chart, pretty of everything, people like kind of pay attention to you. So that was the way things were like back then. I mean, things are a little bit different now.
A little bit. I mean, it's very. I mean, it's kind of the idea from last week, right? That the asset class was very, very old school, very rudimentary, and he kind of, despite maybe thinking that the timing was a little bad about leaving tech to come to finance in 2008, 9. That was a time when people could make a lot of money doing things that were very basic.
And the traders they're like doing really well, but it was mostly they were trading the flow of money rather than trying to like
come up with their own.
Come up with an idea or come up with something which produced alpha.
So what did you then? So you move forward, and like how did you?
Decision to what?
No, so then you moved the decision. You spent a couple of years, 8 years or so doing that.
Right. So eventually, like it got like to a point, where the bank will only pay you so much, and like there's a new excuse not to pay you every year. It's like the oil traders lost money, so we can't really pay you. Or the next year it was like, we really can't pay you because we pay you, we can't pay anybody of your colleagues, we can't pay any of your colleagues. So do you really want us not to pay anybody else and just pay you? Like, fine. So eventually it got to a point, and eventually, I decided it was like easy enough that I can do this on my own. And I was very fortunate that way because I was trading like futures. It's not like some fancy over-the-counter stuff or like that. So I can pretty much trade this by myself. I don't really need the help of a bank and a bank for resources. So at one point I decided, I can trade this by myself. So I pretty much quit and started on my own. I even interviewed for a couple of hedge funds, but this is Houston, not really interested. And it's been great since. Like right now, like I'm making like probably and order of magnitude more. I work probably 4 hours a day, and I'm watching Netflix during those 4 hours because I'm the boss.
As a disclaimer to that, there was a lot of work that did go into, his domain expertise and, the last 2 years.
I mean, thing is, once you understand a thing, once you develop a niche, you know what you're doing, you don't really, it's not a lot of extra work.
That is true.
I
The
mean,
last
the
2 years have
sport-
been very volatile too, as well.
Yeah.
A lot of volatility in the commodity market.
There is a lot of stress on trading on your own. Markets keep
great.
going up and down. You lose money, and it's not fun when you lose money. But
Okay.
that's just a part of what it is.
So we're going to actually hold on that because we're going to talk about that later.
Okay.
But so then, so again, so Makul now from a bank, great place to start, kind of manages the money. So it's pivots to Thompson, who similar path to start, but now does work, effectively in an institutional setting still. And so there are some differences, right, in scale, payoff, right. And so I'll gonna hand it over to him to let him sort of introduce himself. His similar path, but where the differences are, and then I think especially now, what the role is that he does a little bit differently. So we're gonna hand it over there.
Cool. Thanks, Max. Yeah, Makul, you sound like an old jaded commodity trader, but I'm there too. So I mean, my beginning, I was at Columbia, and at the time, the hot thing was investment banking. Everyone wanted to do investment banking, and if you didn't get a banking job, you sucked, whatever, right? And of course, it was so competitive that I actually didn't get any banking job and ended up in sales and trading, which is how my trading career started. So it was almost a little accidental, so to say, but fortunate, and I've been doing it for the past 13, 14 years. Just kind of same vein as Makul and Max in commodity index. So yeah, I mean, look, I think Makul probably comes from a more analytical and technical background, and there's just a really wide variety of traders in the trading world, right? And there's a wide variety of opportunities, and there's no right one or wrong one. You basically find your niche and you go take it to wherever you want to go, right? So I am definitely on the less technical side. I still use Excel sheets, which probably is embarrassing, with some Python kind of sprinkled in. But every time when I was at Morgan, the summers come out and stuff, they're all super coders, and you're just oh my god, I've been left in the dust. But I still manage kind of my own way, but like I said, it doesn't have to be big data, world. I mean, it's trending towards a more big data world, but the whole point of trading is if you think you have an edge somewhere, then you utilize your edge however you can, right? It doesn't have to be something that's rocket science or something that's overly quanty or whatever. There's just a whole range of traders. Some of my most my best friends that are super successful, some of them didn't even graduate from high school. So and then of course there's the Renaissance, right, who are super successful, and they're all PhDs and astrophysicists and stuff like that. So there's no mold, so to say, for a trader, right? You're just at kind of a zero-sum game, and it's just okay, how do you hold on to your money, and how do you kind of get money from other people? And that's why people kind of say good poker players make good traders, because, well, that's basically the name of the game, right? So from that perspective, I would say I'm kind of on the less quantity spectrum, but I've made it work for my career, and I still do kind of the same stuff now. So yeah.
So I guess, an interesting thing to sort of pivot then is, how does a risk decision get made? Because at the end of the day, the buy side, like we said, and that is the real, thing that you're measured on. It's what is P&L? And, it's a little different at a bank versus, it's very much more of an absolute return game. But, I guess, Thompson, maybe you could start, how does a decision get made? I mean, obviously, past the trading, for example, what is like the larger sort of, I guess, investment process at a place like Gunvor? And, does it differ than, than what you did on the sell side?
Yeah, I mean, there's probably one major difference. So I'm going to assume you guys have gone through VAR and what risk metrics are and stuff like that on the buy side. And, anytime you manage your own money, you just want to make sure you are aware of your left tails, right? And I say left tails because like most of the times people don't give a shit about their right tails because, wow, I made money, I'm so good. So I think the big difference is people always say you have a VAR, and this kind of goes back to the left tail, right tail thing, especially in trading. And there's a good poker book about it called The Biggest Bluff, but you're going to have variance in your trading. And what you kind of need to understand is that, like, is it luck or is it skill? Or rather, is it luck or is it your edge, right? And most of the times when things go your way, you don't ask any questions because you're just like, oh, I'm so good. I went my way. I made $1 zillion, right? You don't ask any questions. It could have been luck. It could have been skill. You don't even know. On the downside is generally when people ask you questions, right? So whatever your VAR is, no one asks questions on the upside. Everyone asks questions on the downside, right? And probably the biggest difference between sell side and buy side is the questions get asked a lot sooner, right? So obviously no one likes to lose money, but certainly everyone wants to understand why they're losing money. Sometimes the answer is it's just variance, right? But it's a really crappy answer to give, but sometimes that's the truth. So I would say the big difference is, especially in Makul, is like amplified 10x, right? Managing your own money. The downside kind of factors kick in a lot faster when you're on the buy side than when you're at a bank, because when you're in a bank, you're just contributing P&L into this giant pool. And chances are there's enough diversification. It doesn't really matter, give or take, whatever X millions, right? Whereas if you're accountable for your own book and your own money, the downsides, are definitely amplified. Definitely, you have to react faster, or decide whether you're going to react at all, which again comes back to like, is it variance or is it a bad outcome from your system, your strategy, whatever it is, right? So to me, that's the biggest thing. Like, you have to be accountable a lot more whenever you draw down, whenever you have negative outcomes. The accountability is a lot higher when you're on the buy side versus at a bank, which is why if you want to learn and you want to grow, a bank is just very good sandbox, because no one's going to kind of hit you over the head for downside losses and stuff like that. It's a great way to learn.
Yeah, like going all the way back to week one, right? I mean, like how you are a good bank employee can express itself in a lot of different ways. And especially now, I mean, I think as business lines have diversified and, I think the industry has diversified a bit, you can be very successful and not necessarily be the big swinger at a bank, right? Still get paid decently, great life, fly all over the world, whatever it is. So, for the people that, I know most everyone here is a grad student, but if you are an undergrad, there is value to getting sort of that optionality. And, effectively, where people always say you work at a bank, you have purchased, a put on your career or on your payoff, I guess, at the expense of somewhat selling a call, right? So like the upside is going to be less than if you go to, a hedge fund and you make $1 billion, you will get paid more at a hedge fund. But if you're in the place where you're not exactly swinging for $1 billion and you're still trying to develop your own craft, like banks, and especially post all these pay raises, like we said, it's a very good opportunity. I mean, I think starting analysts now, so that's usually people right out of undergrad, make between 110 to 120 as a base salary, and they'll get paid 30 to 40 as like a stub, probably. For just kind of like getting a BA, it's not terrible. And again, it's a very interesting kind of first step. But But anyway, so let's turn to Makul. Like you said, Thompson mentioned, tenfold difference, right? How do you think about when to cut, the risk process on your side?
Right. No, so I mean, I think Thompson kind of said it already. So like the sell side is like the bottom of the pool, right? So nobody really cares. You can do whatever you like. There's no accountability. It's a good sandbox. It's a good place to learn. The buy side is somewhat better. You're kind of accountable to your your clients or the people who are actually putting the money in. So you have like some responsibility. And I guess mine is the extreme case, because it's my money. So I think the way I do my risk management is I pretty much look at like it's not very dissimilar to like what a bank or what like a buy side would do. I look at like when I'm putting on a trade is what is the maximum amount of money I would lose for that particular trade, and it's kind of based on that. And if it's an amount of money which makes me feel that I won't be able to sleep at night, I won't do it. And especially when you reach my age, like sleeping well at night becomes like really important. Like,
How do you think about conviction? Like when we were used to like toss around ideas. Again, you're at a bank, we'd be like, oh, let's put it on.
Right.
Doesn't matter.
No, so I only trade like very high conviction ideas. And I've seen like when I trade a low conviction idea, I usually like even like get out at the wrong time. Like because since it's a low conviction, I'm not sure like how much money I can make on it. So when I like get out, I get out too early. And when I lose, like I lose too much because I don't know when to get out. So that is why it's better not to trade low conviction ideas, even though they might make you some money some of the time. So it's better just to trade on the high conviction ideas so that, even if it's losing money, you're still confident of like hanging on to it and even like maybe like putting on more also in some cases.
This is like the idea of like good risk, or so I say good losses and bad losses. So as just echoing some of the things they both said. So as an example, I think we've had a killer year this year. Both myself, the desk, the business, the bank. So I had like the worst day of the year. I think 2 Fridays ago, and of that, whatever the substantial loss. 95% of it, in my mind, is a good loss in the sense that there was this thesis. The position was, well sized based on some, historical risk metrics. And, to Tom's point, there's going to be variance. Like there are going to be days that you were just wrong.
No, and it hurts much more when you're doing something which is like Max had mentioned before. Like it hurts you emotionally when you lose money, but it hurts you much less when you're following your process.
Right.
Like when you do something which is like outside your process, then you kind of like blame yourself for it. But when it's inside the process, it's like it's part of the noise, like Thompson said. So you have to deal with it.
And it's not just you, like other people will blame you for it as well.
Right.
Like 5% for whatever reason, lost $1 billion in credit default swaps. That's not really in my mandate. And yes, obviously I couldn't probably trade that. But as an example, that's where people get annoyed. And I think if you have a good manager, good desk head or whatever it is, or PM if you're a sub PM, like they will understand that, right? And they understand that it's a risk-taking business. And that goes back to the idea of like, where do you work? That, there are a lot of places where, I think, maybe Thompson, you agree, like a Millennium, for example, they've said that they're making some shifts, but, historically they've been somewhere where they really cut off people very quickly. And, you lose money, that's it. And they'll move on to the next version of you.
Yeah, so one more thing, like I don't believe in like stop losses. I just don't do any stop losses at all. It's just a bad idea for me to do stop losses. Like whenever I've done stop losses, it's worked out badly. Like I get out at the wrong time. Like, the worst point you get out when you do a stop loss. I just don't do stop losses. I have like a well-defined process of when I want to get out. And I'm going to get out at that particular time or that particular point, no matter like what.
So yeah, that's the idea. So I guess, since we're about halfway through now, like why don't we pivot to that idea of sort of loss? And like I said, it's different from Makul as for Thompson. They're different than from me, but I guess Thompson to start, how is your ability to, manage and like how you feel about a big down day? How has that emotional utility curve changed, over your career as well as, as you're where you are now, where it is kind of like the main focus? And how do you deal with it, I guess?
Well, first of all, 99% of the time, losses are not my fault. It's just the market. Yeah. So I mean, losses are part of it. And this is, again, why trading becomes somewhat psychological, right? And this is why trading coaches have psychology PhDs, etc. It's a big mind game, and losses can affect. So losses always affect you 2-3 times more than gains, and you do it long enough, you know, like you don't even care when you make money, but when you lose money, you like lose your mind. And that's just like the way it is, and the way human nature is just losses just affect you a lot more because 1, you hate being wrong, 2, you've lost money, and then 3, you start thinking, oh my God, will this go on forever? And so you can get yourself into like a pretty deep mental pit, so to say, which is why, you know, I don't know if you've, you know, like the general thing is like, you shouldn't get too high in your highs, too lows on your lows, like something that's really easy to say, it's like ridiculously hard to do. But I mean, in terms of losses, you know, I try to just block them out. That's kind of the best way to go about it, but it's really hard, and you're gonna lose sleep over it, and you wanna make it back right away, and that's when you get yourself in trouble, right? Like the instant you start trying to force stuff, you know, it's and again, the traders in this universe are quite different, right? Like I think I am also relatively more systematic, so I have a system to lean on, so that helps with losses, right? It's like, okay, I had a loss, but like I was going to do this anyway, so you know, so be it. On to the next one. Yeah, you know, some traders don't do that. Some traders will stare down their trades for many like percent and millions or whatever, and they just play for convexity and stuff like that, right? So it's a totally different game. I mean, some of my, you know, I call some of my friends psychopaths because they can lose so much money that I wouldn't even know how to sleep at night. But, you know, to them, they're just like, whatever, it's cool, come back. Like, you know, this is what I signed up for. So I think mentally, it's just, what did you sign up for? Can you block it out? Because if you're in the game of trading, you gotta believe that over the long term, you're gonna make money. If that's not the case, you shouldn't be in trading, right? So losses are going to come. They're just part of life. And how do you not let it affect you is just the main thing. And it's a really, really hard thing to solve and just really different for everyone.
Well, I think, and also I have preface it. How can you go back to like, you know, the first days when you moved to, you know, Quant Roll Capital? Now it's like very successful, but like the first days, how was it?
I mean, even though the name of the company is like Quant Roll Capital, it's not all that quant. You know, I just do what I want to do. Just let me preface that. No, so in the beginning it was much harder, right? And so what I did was I traded like extremely small size, and I tried to like prevent any kind of a drawdown. I mean, but in the sense I already knew what I was doing, and I had like very few losses like when I started trading. So I was like extremely fortunate that way, right? So I had like, you know, almost like I was making like out of 5 days, I was making money like 4 out of 5 days. My Sharpe ratio at that time when I started out was like 8 or something like that. So at that point, you know, but even the days which I lost money, it still hurt a lot. And I mean, like Thompson said, you get used to it to some extent, and now it's much easier for me compared to like when I first started. And you need to like block it out to some extent, and especially intraday nowadays, it's like I've seen that like I was not joking about it, but I do watch Netflix and HBO and Disney Plus the entire day while I'm trading. It just kind of helps to like block out some of the noise which goes on in the markets all the time, because most of my trading is like kind of automated. I just need to watch everything. So just to prevent like going crazy by looking at the markets all the time, I have one screen which is like dedicated to playing something on the side.
And then past, you know, the intraday stuff, like while you're working, you know, how your father, you know, you got a family, like how, especially since you worked at home.
Yeah. So in the beginning it was easy, you know, like my wife could, like when I was finished working, which was like 1:30 in the afternoon here, my wife could immediately tell whether I'd lost money or made money. You know? She could like look at my face and figure that out. But 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 you get used to it. I mean, once you start doing it, you get better and better. And nowadays, like some days I'm losing like 6 figures and I don't get affected by it much.
Nice. So I think it's a valuable, like Tom said, there's like definitely mantras that people will tell you about, oh, your high should be the high, low should be low. It's hard. And to add on to another one of those, which again is almost impossible, but in reality, like your emotional payoff should be very path independent. So like how you feel, or you should strive to feel the same way about a loss when you're up $100 million as you do at the beginning of the year when you're flat.
So that is the problem of working with a bank. Is that
Right.
you start at zero, right?
Start at zero.
Because in a bank, you start at zero, like at the beginning of every year. I don't know whether that works for the buy side too. But for me, I don't start at zero. It's not like beginning of the year, anything is reset. Nothing is reset at the beginning of the year.
Right. So goals are a very, very, a very niche side of it. But it's true. I mean, there is no worse feeling than having a great year and you drop to zero and you got to do it all over again. And then the reality is that, especially whether you're at the buy side or your sell side, you have people that are breathing down your neck. There is some path dependence to the fact, like if you have a bad January and now all the equity is reset to zero, it doesn't feel great, right? So like your net, if you look over 13 months, you're still up a gajillion %. But really, from a financial fiscal year, you only look at the 1 month, and now you're in a hole, maybe largest drawdown that you've ever been in. It's an interesting thing, and you really have to sort of be able to stick with it and see past kind of the noise, which I think daily P&L at the end of the day is going to be mostly noise, right? What you're really looking for is like how do you generalize over a month? Is your monthly return mostly almost every month positive? That's really, like, I try to tell everyone that's on my team now, like I don't let them really look at the scorecard day over day. It's really just, how's the week, how's the month, and then that adds up. I guess Thompson, how do you think, because also, you were in a co-global head position. Is there an expectation that people will have a down year? Is saying that I'm never going to be negative on an annual basis, like, is that not realistic?
I mean, yeah, I think again, it just depends on the type of traders you have. I mean, we were generally more systematic, so I never really expected anyone to be down. I mean, I will say that anyone who's new that comes in, the best thing I wanted them to do was just to lose a ton of money. Mainly because you learn a lot, and there's no substitute for the experience of losing money. And when you start and you make money, you just think you're like the best trader ever, and you are just going to get in trouble somewhere down the line when you start sizing up and things get really crazy. So I think when you first start out trading, the best thing that can happen to you is just you lose all your money. So you know where all your mistakes are. And look, I mean, when I've had good drawdowns when I was an analyst, and I've certainly lost. The first thing my boss told me when I joined was he sat me down. He's like, "Yeah, I know you think you're great, and like, in the interview, you told me how your equities are doing so well, and like, he was like, let me just tell you, you're gonna lose $2 million for me at some point." And he's like, "I don't even care. I want that to happen. But just don't hide it from me." So, so obviously he had another message there, but I totally agree with that. Like, I think you don't learn anything making money, especially when you start out. I mean, obviously, once you've done it for a while, you don't want to lose money. But you at that point, you've learned enough about where the pitfalls are and where the mistakes in your processes are. But until you learn that, and everybody's style is different, right? So no one can teach you, hey, like, don't do this, because it's your own style. But what was I saying? Yeah, I mean, the expectation, of course, later on is that you should make money every year, just because that is when you or an old interview question at Millennium, of course, is like, they'd be like, in 3 minutes, describe to me your edge. And that's a very valid question, right? So if you're a trader, you should be able to sit down with someone and just tell them, here's my edge, in a really concise way. And they should be able to say, okay, that makes sense, or that doesn't make sense, right? And if you can't do that, you should question why you're doing it. Is it just randomness that you're after? right? Because then you're really just gambling, and kind of saying I'm trading, but I'm really gambling.
Yeah, I mean, and I think the edge also is not just, your past results, right? Because again, that's just, somewhat of a path-dependent realization of how things have occurred. You should be able to articulate, what it is that you do differently. And again, trader and portfolio manager is interchangeable at this point. Maybe the way that things are done are a little different, but I think that you should know, it's a valid point, is can you self-describe what you add that, someone else doesn't do, or that at least that, is something beyond, oh, I have experience. And I said, as you go to interview on the buy side, which is in theory where most people want to end up at some point, they get thousands and thousands of applicants who all have some track record that's probably positive, right? Or else they wouldn't even be in the door. So, it's a very good kind of self-awareness thing. And it does help you sort of be able to articulate why, give justification to what the results were, and maybe, push you along that path that you think you are doing something that is sustainable, statistically, different than zero. So we have 10 minutes left. One last question is, to Thompson, both of you are on the sell side, and obviously, you're on the buy side now as well, but I don't know that a lot of people are going to be able to kind of go down your path. How is it the difference? Everyone on the sell side always says, oh, life would be better if I was on the buy side. Now, actually, you see a lot of hedge fund people sort of actually trying to look for the sell side jobs because, pay is not so different. They want to go trade flow. Since you've kind of seen both sides of the street, and I think you worked in Chicago in a fund as well. What would you say to the people here that are trying to decide which route to go, and is the grass really greener on one side, stuff like that?
Yeah, and it's a good question, and it's a question that you guys will go down as you go through your career. I mean, the way I guess the way I would describe it is context matters. Right. So if you have $2 in the bank, okay, let's try not to risk it all on a buy side job with no security and 3 kids or something like that, right? Context matters, because if you had $100 million and you go to the buy side, you don't make any money, no one's crying for you, right? It's okay, you're going to survive. So one, of course, like your situation matters, right? Two, the what you actually want and the aggressiveness of what you want matters. Like, if you want to be Axelrod on billions, you're gonna have to go to the buy side, right? If you just want to live a really, really good life, you can do it on the sell side. There's nothing preventing you from doing it on the sell side, right? So your ambition matters, like what you want to do matters, but it's all. I think the biggest difference is if you feel like I think everyone should start out on the sell side, first of all. I think it's a great learning experience. It's a great place to hone your craft. And the time when you should leave, and I've been told this way, way back when, and I ignored it, and it turns out to be right. But the time when you should leave is when you feel like you no longer have any sort of like learning equity at the sell side place. You're just kind of like going through the motions. I've learned everything I could. I've made all the mistakes I could. And now I'm just kind of like robotically making money, which is a good thing, right? But it's a better thing to robotically make money on the buy side because it's better for you on a selfish kind of level, right? But until you've exhausted all that equity, the sell side is actually a really great place. And generally the people who get quote unquote frustrated by the sell side are the really good traders and kind of like, they want to do it for themselves and take the risk, right? But to me, there's nothing wrong with the sell side. I think it's really great. I think it's a really great incubation type thing. Learn as much as you can from the sell side before you try to do anything. I mean, this is my opinion, of course, right? Because I think at the end of the day, trading's very unforgiving, right? It will humble everyone. It'll like crush your spirits. It's not as fun as everyone makes it sound when you're like, yeah, I'm making $1 billion. It's not always like that, right? Sure, hopefully you'll get to experience some of that. But it's a zero-sum game. There's a lot of smart people in the world, and there's Ken Griffin and his army at Citadel and Renaissance and the army of astrophysicists. That's the competition you're fighting against, right? So it's not always glamorous. it's a very, very unforgiving business. But if you can learn and figure it out, it can be very rewarding.
Any closing thoughts?
No, so I kind of agree with what Thompson's saying. The sell side is like a good place to start. Like you learn a lot of things, but like Thompson said, there are not a lot of smart people in sell side. Max, I'm looking at you. So once you spend a few years over there, you need to get out and do something. And I want to give you kind of like a warning. Like a trader job is like, it sounds very nice, but it's like a tough job, and there are not a lot of ways out of it. Because once you become a trader, you don't really have a lot of skills, like which are transferable to like different industries. Like if you go into investment banking, there are like a lot of different things you can do. Like you can go into corporate finance, you can go into private equity. There's a whole bunch of things which you can do. But for a trader, there aren't that many different careers which you can look forward to. So you should be really sure that you want to do something of that kind.
At least, yeah, I actually would agree with that. I mean, I think, if you see or you have an opportunity to go to a desk and they say, oh, we were the second biggest desk or second biggest pod in whatever fund, and they still are doing things in a very antiquated way, you do really have to think kind of like into the long term. We tried to make sure that at least on our team now, there's a lot of code work, and we've had people, we had one person actually just go to Amazon from our desk. And so that is something that, you want to make sure that, especially as you are still determining whether or not it's the long term, that you keep those options open. Because it's true, if you become, a livestock trader and that's all and, you start to approach from a very fundamental way, you can make a lot of money 100%. But if you don't, what do you do after does, that sort of decision space does change a bit. But anyway, so we have 5 minutes left. I got to turn it back to Dr. Ullman. Thompson, thank you very much for Zooming. Guy was in Geneva just last week, so I appreciate your time, and Makul, obviously, for coming down.
You guys have any questions?
Yeah, if there's any questions, now's the time to ask them. And
you can ask me anything.
What's your strategy?
That's the one I don't want to answer, but
go ahead.
but I'll give you some ideas on that. So basically, in an index world, this is what Max also does. Is basically there are futures which need to be rolled. So I kind of figured out like what futures need to be rolled, and I front them.
Rolled?
Yes. So there's like, suppose you have suppose like like Bitcoin, for example, right? The new ETF which came out is going to be in the October contract. Futures have like different months for contracts: October, November, December, and it's the same for commodities. It's like when you take delivery of that thing. So everybody's like in the spot contract, the front month contract. And at some point, they have to roll from the October contract to the November contract because they don't actually want to take physical delivery of the oil or the livestock or the Bitcoin for that matter.
So it just keeps going?
Yeah, so what you do is you sell the October and buy the November. So basically, I figured out like when they are going to do it, how they're going to do it, and I kind of front run.
Yeah, go ahead.
Yeah.
So I'm wondering, what are you mainly looking at in your research? Are you looking at like big picture, like macro stuff, or are you really locked in?
No macro stuff.
Okay. Interesting.
Just what is going to get rolled and when it's going to get rolled. That's it.
But I mean, Thompson, you have again, as the institutional side, you take up probably a little bit of a larger view, right?
Oh, yeah. I mean, a mix of everything. Obviously, same background, so a little bit of what Makul's saying. But yeah, we have some larger kind of macro type positions and stuff like that. It just depends how you want to build a portfolio.
Makul, you mentioned that it's a good thing that 10% of the equity money didn't go into commodities.
Right.
Is that because it would have made things too efficient?
No, it would have made things much worse. So commodities is like a very small market. It's like, I mean, if you look at the sum of all the open contracts, like the value of all the open contracts in commodities, it's probably like less than a few $1 billion. And the market cap of equities is like $25 trillion. I mean, that kind of money just can't. It would just like blow up everything. Like if you try to put that money in commodities, it would just make things really bad. It would make things really good for me because there's a lot of money flowing into indices and commodities. I can front run more of it, so it's great for me.
And I was going, so the market, yeah, especially when you started, was about that size. Now it is definitely significantly larger. The market cap generally is closer to a couple $100 billion across everything. So it's about 100 something
Yeah.
in
It's not,
oil.
sorry, I didn't mean to say a few billion. Yeah,
But-
but it's like less than $1 trillion.
Less than
right?
$1 trillion, I think is fair. But also remember that like OI is just outstanding notional. I mean, the volumes have really picked up. But I think his point is valid that as soon as something, becomes, the asset class or like the main investment vehicle, it does become a little harder for some people to make edge. Like for his world, it'd be great. For other people, it does become a little tougher. As the market does get, you end up being more like the G10 FX space, right? $1 trillion turnover every day. And it's very hard to be a long-term alpha generator in that market. So anyway, as just as a side note. So that is 11:50. I know you're time sensitive. Dr. Dolman, I don't know if you want us to.
Well, we can dismiss everyone who needs to go, but I am more than happy to hear more questions or
Okay, sure, yeah.
So what do you use to automate your trading strategy? So what system do you use to automate your trading strategy? Should you have it on autopilot and then just monitor?
There's no system. I just wake up every morning and put my trades on.
I think it's like his idea, like his structure is pretty much set. Like it's not really what he's doing, he says, but he's still gonna go, I think, and trade it manually in the market. It's not gonna now go.
But your signals, I think.
Yeah, it's more his idea is structured. Yeah.
Yeah, so I came with like who's like a professor here, who's like the guest speaker. You guys like both guests.
The two people, Mukul and Thompson are the guest speakers, yeah.
And are you like a lecturer here?
Yeah, I guess so.
Actually, he's a special lecturer for this class. Bruce Shu is very good at trading.
No. Who's gonna say that again? So like.
I mean, the biggest thing about trading is or trading or investing as such, is you need to come up with different ideas. Or you need to think like outside the box. I mean, for me, my job is a very lonely job, but that makes it, kind of easier because once you talk to a bunch of people and
Figure out the right ideas.
figure out the right thing is, that means everybody knows what the right thing is, so that there's no alpha there.
Wait, you said there's no what?
I mean, if you're discussing your idea with a bunch of other people and they all agree with you, that means the market kind of already acknowledges that.
Right, so you want to do something else.
You want to do something different,
make
or you want to think outside the box.
Right, you want to like move contrary to
Yeah,
the mass.
yeah. So you need to like think by yourself. I mean, you better not get into like group think.
Right.
It's very easy when you discuss ideas with a bunch of people. You'll pretty much get the same ideas as them, or you'll pretty much think like them. If a bunch of people believe in something and you respect them, you'll automatically start believing in the same thing.
The social media indicators, are these just an example of an indicator you don't have time to fool with?
I mean, it's of no use to me. I'm not saying it's something which might not be useful. It's just something that's not useful to me.
Go ahead.
Do you have any advice for thinking outside the box, like you say, especially for someone like in our position who might not have the same level of experience? If you're depending on those people.
So yeah, you need to start out and gain some experience, and that is probably like done at like a larger firm or something. But after that, I think especially in the American culture, there is like too much emphasis on hard work. I don't know, I guess that's because like, we're historically cattle farmers or whatever, where, more work you do, the better it is, but it's not like that anymore. It's like a knowledge economy, right? Something which takes 20 minutes, you can spend 3 days doing it. So, I mean, the number of hours which you put in is like not really that relevant, but thinking outside the box or coming up with something new, that's what counts. I mean, all the rich people in the world, they're like 1 million times richer than me or you. It's not that they work 1 million times harder. Right?
This is actually an interesting question, Thompson, too. I mean, I think, one of the satire things that as soon as you join the buy side, the first thing you do is go to every dealer and ask for their playbook. And they will, because the salesperson is there to try and help you, help themselves sell products and stuff. How do you get viewed as like adding alpha and thinking outside of the box past, the fund just investing directly with the bank?
Well, I mean, generally the stuff, I mean, it kind of makes sense. I mean, the stuff that dealers or as Max was saying, dealers are the banks, right? They offer products that institutional investors can buy and stuff like that. I mean, obviously they're not 5 sharp 0 drawdown type strategies, or else they wouldn't be selling it, right? So they're kind of already just like okay, just like off the shelf, but not that they're bad, right? So like I think, Max, the question is like, you know, I don't think there are actually a ton of good off the shelf stuff that comes from dealers. How you can make it better is a little bit of like tweaking and portfolio kind of theory, how to combine them in different weights and stuff to get an actual better sharp if you wanted to go down that route. But certainly, you know, there's a decent amount of tweaking in the sense that you know, no one's going to hand you the rule book and the playbook for something that actually exhibits long-term alpha, right? It just wouldn't happen. So I think you taking it from that lens, you kind of have to assume everyone's rational. No one's handing you something that makes free money. Just like, you know, any of us wouldn't just openly say, oh, here's exactly how we trade so that you can go copy us. You know, I don't think that's, you know, I think it definitely needs to, it's kind of like a baseline, you know, it's like a salad bowl that you got to add all the ingredients into, but you know, sometimes it's a decent baseline.
Anything else? We're gonna call it a week.
Cool.
Oh, got it back.
Do you like figure out what features other people are rolling, or do you like figure out what features you own that you should be rolling?
I couldn't hear you.
So it's like, do you own the futures you roll, or do you go look for the futures in the broader market that you think are going to roll?
I mean, there's only a limited set of commodities out there. So you just look at which commodities are on the index, and based on that, you figure out which ones you want to roll. I don't know if that answers your
He
question.
doesn't actually own it, because then if you own it, then you have
I
the
never
market.
I never take delivery.
Yeah, and that's also directional risk past the rolling period, right? Like it may be like he thinks that something's going to happen for this day, but if you own that, you know, it's effectively going to be, you have the whole month before that, right?
I'm effectively a day trader. Like I get in the morning, I get out by the afternoon.
Okay, so I'll leave it there. Next week, we're gonna talk about FX. A lot of stuff, we kind of similar to our commodity talk from last week. I said I'm in town for another, you know, well, I guess 1 week after this. And so if I've already met a couple of you guys. If you have any issues or questions, by all means, you know, reach out.
Thank you, Makul.
Thanks,
you,
Thompson.
Thompson, and thank you, Max.
All right, no problem. Good luck, guys.
Got to run to the bank.
Yes.
Of course, that.
Thank you. Good. So you use first notice date, I assume, not your rolling strategy.
No, I just.
He's gonna give away. This guy's gonna give away. He's gonna probably bankrupt himself, but.
Seems like a very interesting topic. So is it because of, I guess, the lack of players and commodities that this strategy has so much success? Because it seems like if you have an index that you know is going to rebalance at the end of every month, just based on the size of the position and success of the constituents,
I mean, all the
you can do
data.
this in other places.
No, so all the data is not very transparent.
Okay.
So
No.
some of these documents are not public.
Okay.
And some of it is public, but you have to really figure things out. And like you said, there are fewer players. Some of these things work.
But ideally, would that strategy work for another index? But it just might be more crowded, like.
Yes. So if it becomes crowded, it doesn't work.
Right. Okay. Yeah. Okay.
So yeah, when it's crowded, it doesn't work.
Okay.
So that's why sometimes it works a few months and then it stops working and then it starts working again.
Gotcha.
So that happen.
Okay.
So yeah, so if a lot of people try to do it, you lose a bunch of money.
I understand.
That's how it is.
Thank you for your talk today. I appreciate
Sure.
it.
I'm Bruce. So when you say you're commodity trader, do you like trade on like wheat, oil?
Thank you, Dr.
You say you're more like a speculative kind of guy.
I mean, anybody who's not a hedger is a speculator.
Like you don't like hold it, right?
I don't know.
You buy up and downs.
I'm working on my.
Not really.